Good morning and good afternoon, everyone. We're just going to give this one more minute to let people filter in, and we'll start promptly around 10:01. Thanks. Hi, everybody. Thank you so much for being here today. We really appreciate you taking time to learn about the top opportunities that we've been going over the last couple of weeks. We've got Rob Beatty on the line. Just a little housekeeping. If you have any questions during the presentation, just write them in the questions box, and I will make sure that I cover them with Rob at the end, and we do answer all your questions. And without further ado, I'll let you take it over. Here you go, Rob.
Thank you, Allie. Thank you, everybody. Good morning, good afternoon, wherever you are. Thank you for joining us on the call today. Today's topic of conversation, this is an opportunity. This is asset-based long-term care is something that we have a tremendous amount of success and productivity with here at CORE. We've wrote approximately $18 million in premium last year in asset-based long-term care. And why is it so successful? Listen, this is a topic that clients want to hear about. Just the general long-term care planning topic. Some people in the business are trying to change the term from long-term care to extended medical care. However you position it, it's a topic of concern. We're going to get into some of those statistics. And quite frankly, it's one of the least distributed products in the risk management realm. Less than 10% of the population has some form of private long-term care insurance coverage in place. And, there's two ways to look at it. I'd like to tell a story, the shoe salesman story, about two shoe salesmen are sent to a developing world country where very few people have shoes. The first salesman gets off the plane, looks around, calls his boss and says, "Look, nobody's wearing any shoes. I'm coming home." The second guy gets off the plane, looks around, calls his boss and says, "Look, nobody's wearing any shoes. Send 3 freighters of shoes." I look at long-term care in all of its manifestations and solutions, and what we're going to focus on asset-based today is the same thing. It's a wide open market. It's a market that consumers say they're very interested in. The problem is the consumers don't necessarily even know what questions to ask, let alone what solutions they should be seeking out. But the polls say they want their advisors to start talking to them about it. So today we're going to cover asset-based long-term care and the tools and solutions that we have available through CORE. So here's a statistic. 70% of people over the age of 65 will need some form of long-term care services, whether it's home health care, assisted living, full-blown skilled nursing facility help, or some phase throughout the process as people get older. I have relatives now that are in assisted living or need home health care visits just to get through the day. The average length of a long-term care stay lasting more than 1 year is 3.9 years. And the average life expectancy after an Alzheimer's diagnosis is 4 to 8 years. Some people can live 12, 13, 14 years with a mental deficiency diagnosis such as dementia, Alzheimer's, those types of illnesses. So if there was a 50% chance your house was going to catch fire, would you insure it? I had placed an asset-based long-term care with a physician, and they said to me, and they bought the policy, but then they said, well, they went and talked to another friend of theirs who's also a doctor, and they said, well, why would you do that? You can self-insure that risk. So why would you buy a long-term care policy? So the analogy that I came up with was, okay, then why would you buy a homeowner's policy? Why would you buy car insurance? If you're a doctor, why would you buy errors and omissions coverage? Because I'm going to tell you, the economic consequences of your house burning down, your car being wrecked, or you wrecking someone else's car and injuring them, or even a malpractice lawsuit as a physician, the economics of it, the economic cost of a catastrophic medical expense, uncovered medical expense in retirement, the dollar amounts approach, if not exceed, any of those three outcomes. So, 0.317% of households experienced a fire in 2010, less than 1%. 1/3 of 1% of households experienced a fire. And yet everyone has homeowners insurance. Now, if you have a mortgage, it's because they require you to have it because they don't want to be on the hook if the house burns down because it's a non-recourse loan, so they want you to have insurance. But even if your house is paid for, why do people continue to pay homeowners insurance? Statistically speaking, it's a very low probability that you're ever going to lay claim on that policy. And if your house is worth $500,000, well, geez, and you're worth $5 million, can't you self-insure that risk? The lifetime chance of someone who buys a policy at age 60 that will use their policy before they die is 50%. 50%. So it's a flip the coin probability, and yet people don't tend to do it. And the doctor that I just told you about rescinded the policy, took their money back, and I'm like, and they had the money, right? And it was sitting in a money market account at the bank earning virtually no interest versus leveraging it into a 4 times pool of asset-based long-term care and having at age 80, when they most likely would go on claim, a $1.2 million pool of income tax-free long-term care benefits. It's amazing. So anyways, these are the statistics. It is a high probability that people will need it. So why asset-based long-term care? Well, traditional long-term care, one, there's very few players in the market, right? They had a tough time getting the pricing right in the early days. Any of the players that are still in the market, every week I get an email from Genworth, because we're licensed with Genworth Long-Term Care. I personally own a Genworth traditional long-term care policy. Rate notifications. Every single week they are raising their rates in one of the 2 or 3 of the 50 states, and they can't raise them fast enough. Now, I will say that when clients come to us with a traditional policy and they've got a Cadillac plan and their annual premium's going from $3,000 a year to $3,500 or $4,000 a year, it's like, you need to keep it because that's still a screaming deal, what you have for what you're paying for it. But what's the problem? It's like car insurance. If you don't use it, you lose it. So you pay your premiums all your life into a long-term care policy, and you die and never lay claim on it. They don't give the money back to your heirs. So it's like car insurance. If you don't have an accident, well, there's never any payout. So most people's hesitancy with traditional long-term care is, if I don't use it, I lose all that money I paid. The second issue is that the premiums aren't guaranteed. As we know, people are getting notifications of 50, 75, 80, sometimes 100% increases in their premiums. So there's no guarantee what the expense of that policy is going to be going into the future. So, and the insurance companies, quite frankly, have a difficult time reserving for that risk because they don't know what their exposure is and what expenses are going to look like in the future. Now, they know they've got a finite pool. The policies that really bend their minds are the lifetime policies, where it's an unlimited benefit for the lifetime. Now, it's capped out at what the daily rate or monthly rate is, but they're having trouble with the pricing on those payouts because medical expenses inflate at much higher rate. They also priced in lapse assumption ratios in the 7 to 9% range, and less than 1% of long-term care policies lapse because most people, once they have it, recognize what they have and they stick with it. So a lot of the insurance companies came out with asset-based solutions. New York Life and Lincoln Financial are the granddaddies at this. New York Life had a product out for as long as I can remember knowing what New York Life was, and Lincoln's had their MoneyGuard product out for some 25 years now. So what are the pros? You have guaranteed benefits. You have guaranteed premiums. Yeah, typically in almost all of the products available that we have today, you have some ability to get some or all of your premium back should you change your mind. If you get, you're 5-10 years into it, and you're like, I'm never going to use this. I get a do-over, give me back my money. The money stays with the family if it's never used because it's a life insurance-based solution. So if it's never used, the life insurance death benefit pays income tax-free it has all the characteristics of a life insurance policy. So it pays income tax-free to the heirs. It passes by beneficiary designation, so it avoids probate. Many states, those assets are asset protected. In 37 states, you have asset protection, so while it's sitting in the policy, it's not subject to the creditors of the insured. The stuff's pretty simple to understand. What you see is what you get. The ledgers that we illustrate today are going to be the benefits the client are going to get 5, 10, 15, 20 years from now. It's all, there's not a lot of moving parts there. Some options, you have a one and done where you can do a single pay premium into it where you're repositioning assets. A lot of people have cash on the sidelines today. What interest are they getting on that cash at the bank? Best case scenario, you can get, there's banks out there that are subsidizing and buying business by offering 1.5% money market rates on certain accounts. CDs right now, 5-year CDs are at 1.8, maybe 1.9. So what are they getting? So you take $100,000 and you reposition it, and depending on the person's age, generate a $300,000-$400,000 pool of income tax-free long-term care benefits. What's the IRR on that? What's the leverage that you're providing? There's also, you can pay with cash and transfer from existing cash value life insurance policies to fund this strategy. If you've got clients out there that have a whole life policy with a $500,000 face and $250,000 of cash value, really what they have is $250,000 of cash value and $250,000 of insurance. They're self-insuring the majority of that death benefit or a substantial portion of it with their own money. So what if, and let's say we don't need the death benefit for what it was purchased for, debt protection, if, premature death, whatever. Say, hey, let's leverage that $250,000 into a $750,000 inflation-adjusted pool of long-term care benefits. Can all be done tax-free. Most of the programs that we have are expedited approval process. They have 5, 6, 7 knockout questions. If the person can answer no to all those questions, there's no blood, there's no urine. There might be a phone interview, some type of a cognitive, can the person remember 10 words 60 seconds later? How many of them can they remember? So, it's a pretty expedited process. Now, depending on volume going in at a particular time, but you can get turnarounds on these things in 5 to 7 business days from the time the app's submitted to the policies issued and the coverage is enforced. It can be 5 to 7 business days. And you have the options of reimbursement, traditional reimbursement. You incur the expenses, submit them to the carrier, and they reimburse you for those expenses. Now, typically, once that let's say you have someone that's going into assisted living and there's a steady stream of monthly expenses that meet the criteria for the policy. Once, the initial 30, 60, 90 days, it's going to be send in paperwork, get reimbursed. But eventually you can connect where the vendor or whoever's providing the services is direct billing the insurance company or their service provider, and it minimizes the paperwork. And there's also indemnity policies where once you've met the triggers for a long-term care, 2 ADLs, two activities of daily living that you need assistance with, they'll start sending a check. So let's say your benefit is $3,500 a month. Well, once you hit the trigger that says you qualify, they'll start sending you $3,500 a month in payments until you tell them to stop or the benefit's depleted. So what are the cons? It's best leveraged when there's a lump sum payment used, but it's not required. It typically is going to require $50,000 or more in total funding to get a policy of substance. And then once we get over age 70, right now, quite frankly, given in the COVID environment, we don't have companies issuing much of anything over age 70, let alone traditional asset-based long-term care. If and when those restrictions are lifted, we will have options for clients going up to age 80. But again, the leverage is not as significant from age 70 to age 80. So let's take a look at an example. We have a married 65-year-old female. She's got $100,000 to reposition in the single pay option. So at issue, it generates a $4,275 a month pool of benefits, in benefits, with a total pool of $331,000. So we got 3.3 times leverage on that pool. Then if we look at age 80, which is, again, most claims are going to take place between 75, 80, 85. The benefit has inflated to $6,661 a month in benefits for a total pool of $516,000. That's a 5.1 time leverage with a 3% inflation adjustment built in. If the policy is never used for long-term care benefits, the death benefit it issues $164,000. Now it does decline over time. That's the nature. These policies are designed to optimize the long-term care benefits, not the life insurance. And the way they do that is that over time they decline, the death benefit declines. But from ages 86, the lowest point that it ever reaches, through age 120, it's guaranteed at $102,000. Not a lot of leverage, but at least the heirs get back the initial $100,000. And in this particular scenario, the way it was designed, at any point in time, the client can say, look, I want out, I want my money back, and they're guaranteed to get $80,000 of the $100,000 back at any point in time in the future. It's a 0-day elimination period. So, no 90-day elimination. Once they qualify and go on claim, they can start getting reimbursed for those expenses. And this was a reimbursement policy. So another type of asset-based long-term care is like if we're doing advanced planning and we want to, probably shouldn't say kill two birds with one stone, but that's what we're doing, where we have a significant life insurance need, pure death benefit, but we want to tack on the potential for long-term care benefits. So you buy a traditional universal life policy, $250, $500 million face amount, and typically for not significantly more premium. So if let's say the premium's $10,000 a year, you tack on the accelerated benefit rider that provides these long-term care benefits. Should the client lay the claim, it might be $11,000 or $11,500 a year more, but you get this long-term care benefit. And again, you have guaranteed benefits, guaranteed rates. It could generate the largest of all the monthly options. Now, generally, these options are not going to be indexed for inflation. You also have the largest death benefit, so that if it's never used, there's significant leverage of the premium dollars paid. The IRR on that death benefit is, just from a pure cash-on-cash perspective, the economics make fantastic sense for leveraging wealth to the next generation. You have flexible funding. You can pay with cash, or you can transfer in existing cash values from other life insurance, and some of them provide indemnity benefits. Some are indemnity, some are reimbursement. Depends on what the client's looking for. What are the cons? Because you're getting substantially more leveraged death benefit, the surrender values, you don't get the guaranteed return on premium, or even generally speaking, you're not going to get a substantial portion of that premium back ever. So we need to understand, when presenting these solutions, what are the client's needs? And this is not a liquidity option. And then you have a fixed benefit pool. Generally speaking, there are not inflation adjustments on these, but the issue is that the pool from day one is generally substantially larger than a single premium asset-based pool would be with an inflation rider built on it. So because the benefits are higher out of the gate, there is some level of inflation built into it relative to the funding amount, the alternative fundings at the time of the policies issued. So here's an example. You have male age 62 with average health, standard non-smoker, purchased $250,000 of total death benefit or long-term care benefit pool. The premiums and benefits are guaranteed to age 100. It's a $6,600 a year premium. You have a $10,000 a month long-term care benefit. It's paid as reimbursement. The policy has little to no cash value. Again, this is not a liquidity flexibility play. Premiums are no longer required once you go on claim. So if the client's 75 and we've shown them paying premiums to age 100 to guarantee the death benefit, once they go on claim, they don't have to pay any more premiums. The IRR on the policy, the death benefit, is 7.4% IRR to age 80. The second option in this scenario is you have premiums and benefits are guaranteed to age 88. You have the same $6,221 annual premium. And this is where it's not, the first option is a guaranteed GUL policy, basically a term for life policy. This option is a current assumption index universal life policy with substantial guarantees, typically guarantees out to age 88, 3 to 5 years past life expectancy. So the policy is still in force based upon a 6.35% index rate of return, which is kind of a middle of the road index return. It's not the highest available that you can illustrate in this IUL product. It's in force at age 120. It's got a $52,000 cash value at age 77. It's got a cash surrender value of $128,000 at age 88. Same $10,000 benefit. Premiums are no longer required once you go on claim, and the IRR on the investment at the premium payments, the cash on cash IRR is 8% at age 80. Just another option for funding both, where we're trying to solve both a life insurance and a long-term care benefit. And then we have what are called long-term care qualified annuities. These actually came into being with the Pension Protection Act of 2006, believe it or not. Many people, it was just one of the provisions that very few people paid attention to at the time. The government for years has been trying to figure out a way to get people to pay, self-insure, privately insure their long-term care risks. The largest single payer in our country for long-term care benefits is Medicaid, because most people just don't have the money. They go destitute, they go bankrupt, and then the government pays the benefits. The government, when they came out with the Affordable Care Act, they tried to build a long-term care benefit into it where everyone contributed $25 or $50 a month. They just couldn't make the math work, and so they did not include it. So now the government's approach lately has been to provide tax incentives to get people to use tax-favorable dollars to provide for their own benefit. So one of the things with a long-term care annuity is that you can take, let's say you have the same scenario, $500,000 you have $250,000 of cash value in that $500,000 whole life policy, but your cost basis is only $100,000. Well, you can 1035 that $250,000 into a tax-qualified long-term care annuity. Now, many of the products will offer leverage. The annuity will offer a 2 to 3 times leverage depending on the person's age. But let's assume that for whatever reason the person can't qualify for any leverage. They're too old, they're too infirm, whatever. You can still take that $250,000, of which, there's a $150,000 gain. And in one of these annuities, take the distributions out, take the gains out first, income tax free, as long as they're used to pay for long-term care expenses or they're used to pay long-term care premiums. So you can get the money out tax free. So they're allowing you to take gains from life insurance, from other annuity contracts. If you have an annuity, you put $100,000 into it 20 years ago and it's worth $300,000 today. You can get those gains out of that annuity if you transfer to a tax-qualified long-term care annuity. You can access that $200,000 income tax-free to pay for long-term care expenses or long-term care premiums. So it's just a way to leverage it. Many of the annuity products that we have in this space, from One America, from Global Atlantic, again, they'll offer 2 or 3 times the pool. So you put in $100,000, you could get a $300,000 or a $200,000 pool. And worst case scenario, you get 0 leverage, but you can still access the money, the gains in that contract, to get to pay for long-term care expenses or long-term care premiums. So we got an example here. We have a female, average health, age 70, transfers, does a 1035 exchange from a non-qualified annuity valued at $300,000 with $100,000 in cost basis. You've got guaranteed values in the contract. At issue age, you can get a $12,400 pool of long-term care benefits for 132 months / 11 years. It's a total pool of $1.6 million of long-term care benefits, and you have a $279,000 cash surrender value / death benefit value. So you've given some money up, right? I mean, it's not a guaranteed return of premium, but you still have access to a substantial amount. So is that kind of leverage, a $1.6 million pool of benefits, worth $22,000 in surrender charges? And at age 80, and now in this case, the benefits are reduced somewhat, but you've got, even at age 80, you've got still a substantial amount of money left in the policy for surrender, and still tremendous long-term care leverage benefits. So let's get it right for the client's reasons. You know, we have to, back to our, what is it? Core is always talking about the art of good discovery. You know, we got to find out what's important to the client and what outcomes they want, identify the resources that they have. We can do an analysis and inform the client of their options. You know, does the client have enough money? We just do a simple cash flow analysis. Do they have enough money to afford a long-term care solution? If we take $100,000 out of their $300,000 in cash, can we afford that without jeopardizing their lifestyle, their desired lifestyle? We run cash flow analysis to help with those questions. You know, and then we go into the marketplace, and, you know, here at Core, we represent all of the top asset-based long-term care providers, and we also actually have two of the best and only traditional long-term through Transamerica and Mutual of Omaha. On the traditional side, we've got One America, Nationwide, Securian, Lincoln. We have all of the great asset-based long-term care options available to us, and we'll analyze and say which one's going to provide the best benefit for that client's dollars based on what they said they wanted. So then, once the client agrees with the strategy, we will help with implementation. And then part of our strategy for the client is with most risk management, most insurance. It's, you know, once it's sold by a traditional insurance person and that commission clears, if the client ever hears from them again, it's a miracle. We work with advisors. We work with wealth managers at the broker dealers we work with, at the RIAs that we work with. You have long-term, high-trust relationships with your client. Their risk management solutions need to be managed on an ongoing basis, just like every other aspect of their financial plan. So, and we assist with that. I've worked, Laura, on case design, and myself, we've been doing case design going back 20 years, and can go back to case designs we did 15 and 16 years ago and say, are we on track, and help answer those questions for you and your clients. So what's going to work best for the client? It's too important of an issue to be left to chance. What you can present to your clients, and we have a consumer presentation, a very good consumer presentation about long-term care in general, to establish what the need is, what the probabilities are, what can be done about it. And it covers all aspects: traditional, asset-based, rider-based, annuity-based. It covers all of the optimal solutions. So if anyone has any interest in providing for your existing clients some type of an educational presentation on long-term care, or if you want to use it as a prospecting tool, we have a fantastic long-term care presentation put together. I got to caveat it with, if you're with a broker-dealer affiliation, you need to submit it with your BD prior to use. Most BDs sign off on it on a notification notice basis because there's no securities references in that presentation. So you've got clients, you've got opportunities, we're here to help. So if you go to the Core webpage, this is a resource page that we have to help you. You can, if you don't have a login, contact your relationship manager or go to the webpage and request a login credentials to get into the page. But we've got client review booklets, we've got review materials, we've got MoneyGuard resource library. We have all kinds of asset-based long-term care tools available to you. We don't have the actual presentation available on the website. It is available upon request. We have these, let me pull up some materials here. You know, we've got 5 reasons why you shouldn't procrastinate when buying long-term care. It's a great piece. It's available for you to use for yourself. If need be, we can customize it with your logos. One America, well, I'll touch base on that before we close. Here's another piece that you can say that lays out the pros and cons of all the various options that we discussed today: traditional long-term care, asset-based, no lapse UL with long-term care. It does not have the annuity options on there, but we have pieces on that as well. We've got some social media postings that you can use. Why did that just go away? All right, well, that's not working. There's samples of them here on the PowerPoint. Sorry, my technology's going a little loopy on me. But again, we've got handouts, we've got materials. We're happy to work with you, happy to customize them for your own firm to get the message out, whether it's presentations, materials, social media postings. We're here to help. So that's my presentation today on asset-based long-term care. Look, it's a tremendous opportunity. It's not one of the things you need to sell. It's one of the things you need to inform your clients. And the surveys, the statistics, the clients want these solutions. They just don't. They need help. They need guidance trying to figure out which one of the solutions is best for them. We here at CORE are here to help you. Reach out to your relationship manager. If you don't have a relationship manager with CORE, reach out to our case design team. We've got the tools and resources to help you. Some of our upcoming webinars, we've got one on June 2nd with regards to annuities. We've got one for the estate planning window coming up. The annuity solution is, annuities just aren't for breakfast anymore is what I keep saying. I do want to show this One America piece. One America has if you really want to drill deep into the asset-based care, long-term care marketplace, training, ideas, conversations, One America is offering a virtual university on Tuesday, June 9th. It's a 4-hour, but you can come in and out. You don't have to be on for the whole 4 hours. Once you're signed up, it's not like at a college football game where once you leave the stadium, they won't let you back in. You can sign up for the presentations. And again, you can see what the agenda is. If you want this sent out to you after the call, let us know. It's a fantastic training. One America does a phenomenal job with the training. And the skill sets that you're going to learn in their training, it's applicable across all of the solutions. Again, we're not proponing any one company solutions. We will look at each individual case you bring us and identify, is Nationwide or Securian or One America or Lincoln, which one is going to provide the most value for your client's dollar based on what they said they want the outcome to be. So again, if we can pay attention to the dates, we look forward to it. We're taking a break next week because Monday's a holiday, and we think some people, whether they're leaving home or going on vacation, might extend their stay a little bit. So we'll start back on June 4th and June 9th. And again, if you got any questions, you can type in questions. We'll open it up right now for questions. Allie, do we have any?
We do have a couple. The first one says, what is the best way to determine which of the solutions a client should have?
Well, we've got questionnaires that we can provide you. Ask the client the questions, and then you can bring the answers to the questions, what you have asked, bring it back to our case design team. We will help you identify which of the product solutions is going to best fit your client's needs. And after you do it a few times, you'll start learning and picking up on it as well. But do good discovery, bring us the fact pattern, let our case design team help optimize. They're going to look at all the options, and they'll help optimize which one is going to be best for what your client's trying to accomplish.
Thank you. Another question came through. They have a 75-year-old client, and they're just wondering what options are out there for that client specifically.
Right now, again, a lot of carriers have put restrictions in place because of the COVID situation, and quite frankly, the vast majority of people who are suffering the harshest consequences or symptoms are over the age of 70. So carriers have put some postpones. I think right now, we can bring it to us, bring us the specific client, send it into the case design team at coregroupusa.com. We'll research it. I'm thinking probably right now the best options are going to be in the asset-based annuity long-term care space.
And then the last question, the asset-based products have have expedited underwriting. What is required for the others?
Okay, so for the annuity stuff, there's even less knockout questions. There's fewer questions because there's not as much exposure there. But there are some similar questions, like if depending on if you're trying to get a leveraged annuity product, they're going to say, look, if you're in a memory care unit right now, we're probably not going to offer you the leverage. For the traditional life, for the rider-based stuff, it's going to be whatever the underwriting requirements are for the underlying life insurance policy are going to be the underwriting requirements for the long-term care rider. So for the traditional life with a long-term care rider added to it, that's going to be the most comprehensive underwriting because they're going to be underwriting the life insurance. So the asset-based will have the asset-based life insurance is going to have the handful of knockout questions, the simplified questionnaire, very little underwriting. Biggest thing is going to be a phone interview. The annuities, if you're just going for an annuity where there's not leverage and you're just looking to provide accessibility to the long-term care benefits, there's very few questions and there's no actual underwriting on those products. If the annuity is going to offer leverage, you're going to have a phone interview, and really what they're testing on the phone interview is cognitive impairment.
Thank you so much. I think that was the last question that I saw pop up. Thanks, Rob, for doing this for us today. And just to let everyone know, this webinar will be available on our website on that page that you saw earlier, the Advisor Resources page. And all of the pieces that Rob showed will also be available there, but you can always reach out directly to me. My name's Allie A. Peters at coregroupusa.com. If you're looking for something specific that we did not show you today, we likely do have it from one of the carriers or something that we've generated ourselves, and we can cater it, design it, and brand it to your firm. So we appreciate you being here. Everybody stay safe and healthy, and we'll see you on our next webinar. Thanks, Rob.
Thank you, everybody. Thank you for your time today. Have a good holiday weekend.